Hello and welcome back. In this lesson we are going to look at the property income. The property income is an income which you earn on your property. You might have an extra property which you put on rent and then you might be earning some rent. Although you can understand what rent is, but there is something called premium as well. Now premium is the amount which you receive as a landlord, which you receive because your property is situated in a premium place. Say for example, if you have a property in central London and it is in congestion area, then you might well expect to receive some premium as well while giving the property in rent. Because the property is situated in a very posh area and it is very expensive area, then everybody would be willing to have that property on rent. Say for example, 5 people are after you and you are the landlord of the property. Then what you thought, you said, whoever will pay me more premium, I will give the property to that person. I will let it out to that person. Premium is the amount which they will pay in advance and which will be non-refundable. Say I had a property in a congestion area in London, and few customers came to me, and there were 3 of them, and then I asked for £10,000 premium. Then I was thinking to ask £10,000, and then first of the customers said, I will give you £15,000 premium. Then I started to think, why don't I ask more? Then I asked for £50,000 premium, and eventually I succeeded to get £50,000 because one of the customers was willing to pay £50,000 premium. So I got the premium, and then he used to pay me rent as well. So likewise, this happens when you have a property in very famous place. Then what happens is that then customers are willing to pay you premium. Premium is always paid in the long-term rental agreement, so obviously it won't be for 3 years. When the customer is paying you premium, then it will be a long-term rental agreement for 20 years or 15 years. So it will be a lease. Whenever the word lease comes into the taxation, it is not IAS 17. If you have studied F7, financial reporting, you might confuse it with IAS 17, which is leases in accounting. Now leases in accounting is something else. But we are talking about leases in taxation. So leases in taxation is simply a long-term rental agreement. So it will be long-term rental agreement. So there could be 2 types of receipts which you will receive. So there will be 2 types of income. One will be normal rent, and other one will be premium which you will receive because you had a property in a very famous place. So you had some premium as well which will be received advance and which will be non-refundable. Right? So let's move to our notes then. I have already shared the screen with you. This is page 18 and the chapter number 6 of ACCA 6 notes, and it says property income. Now, there are 2 types of income which you can receive, as I said. One is rent, another one is premium. Now rent is always received on accrual basis, so it won't be on cash basis. I assume you know the difference between accrual and cash basis at this level. Then after that we'll have to deduct the expenses again on accrual basis. Now these are the expenses which are listed down. It could be repairs, advertisement, agents fee, insurance, water rates, bad debts. Then it says council tax, redecoration, and interest paid on loan. Other expenses could also be deducted from this one. Then again, after that it says less only for furnished letting. Now if you have a property which was furnished, then you can also deduct this expense which is called wear and tear allowance. So it will only be deducted if the property is furnished. Then the formula to calculate the wear and tear allowance is 10% multiplied by rent. It says tent here. It is not tent, it is rent. So rent minus bad debts. Now it says rent minus bad debts, but there are 2 other things to be deducted from rent as well. The 2 other things to be deducted from the rent are council tax and water rates. So you will deduct council tax, water rates, and bad debts from the rent. So the formula to calculate wear and tear allowance is rent minus bad debts minus council tax minus water rates multiplied by 10%. That will be our wear and tear allowance, and it will also be deducted from this one. Now assuming that in the question if there isn't any bad debt and council tax and water rates, so there isn't any expense, and what will you do then? And if it is say furnished property, then you will only take 10% of rent because there isn't any expense to be deducted out of the rent. Alright, so you will only deduct, so you will take straight 10% of the wear and tear allowance. Right? So then it will be a profit or a loss. So if your income is more than your expenses, and it will be a profit, and otherwise it is going to be a loss. In the note it says capital expenses are allowed. Capital expenses are not allowed as property expenses, so only revenue expenses will be deducted. Depreciation is also not allowed. If there is a property loss, then it can be carried forward to set off against property income of future years. So if there is a property loss, then it will be carried forward to set off against future property income. We don't know the losses yet. We haven't covered the losses yet, but in the future you will see the losses. If you incur a loss now, HMRC says you can use this loss in the future to reduce the future profit and to pay less tax. Say for example, if you incur a loss of £1,000 in this year, you may in the future, if you are profitable, you may reduce your future year's profit with this £1,000 loss, so your profit will be reduced and you can pay less tax. So it is just adjustment for the tax purposes. You will not be reducing your profit. You will only be reducing it for the books purposes. You are only reducing it for the HMRC purposes. So tax authorities are giving you the reliefs so that you can pay less tax. All right? Now that was our property income, if you see, right? That is our property income. Now on the next page, if you move, it is a premium on leases, right? The next page, on page 19, it is a premium on leases. I forgot to go onto the bottom of the page, so please make sure you download the notes, and please do so so that you can go at the bottom of the page as well. All right? So I am on page 19 now. I hope you can see on your screen as well. So that is a premium on leases. Now, when lease, as I said, in the property income, lease is a long-term rental agreement, and you know what premium is. So how to calculate premium on leases? Now, it is an example given in the notes, which says that if Mr. A is a landlord and Mr. B is a tenant, then Mr. A has given the property on lease of 20 years to Mr. B, and premium is to be paid of £20,000. Now, how to calculate it? Now, the way to calculate it is you will take the premium, which will be £20,000, and what you will have to deduct is premium multiplied by n minus 1. Now, n here is number of years, so it will be n minus 1 multiplied by 2%. Now, in this case, it will be £20,000 less 20,000 multiplied by 20 minus 1, because these are 20 years, and it equals 12,400 in this case. Right, as you can see, it is 12,400. Now, if you move to next page, please, it says rent-a-room relief. Now, this is another thing, rent-a-room relief. Now, although you might, there are two options to let your property. One option is to give full property. Another option is to give just a room. Say, for example, if I have a house and my house has got one extra room which I want to let out to someone. So I am just giving one room, one single room, I'm just giving it on rent. So I have one extra room. I am not letting out full house, I'm just letting out one room. Now if I let out one room, in that case, how to calculate the taxable income? This is the way which is given into your notes. Now please look at your screen. It says rent-a-room relief. Now there are two ways to calculate rent-a-room relief. One is called ordinary way, and other one is called alternate way, or you can say rent-a-room relief. Now, ordinary way is just normal way. You will just take the rent, you will deduct the revenue expenses, and you will also deduct 10% wear and tear allowance. You must deduct 10% wear and tear allowance out of the rent-a-room relief. All right. The second way to do it, you just take rent. You cannot deduct the expenses in alternate way. However, you can deduct, which is called exemption of 4250. Now, there are two ways. One is ordinary way, where you take the income and you will deduct the expenses and wear and tear allowance. In other way, which is alternate way, you can only take rent. You cannot deduct any expense. However, you can deduct a standard 4250 exemption. So this 4250 is a standard exemption. You can deduct this one out of the rental income. Now this 4250, if the property is owned by two people, say for example spouse, then it will be divided by 2. So for single person it will be 2125, and it says if joint owner. So if the property is owned by husband and wife, then it will be divided by 2 in this case. And it says beneath that, no expenses deducted. Alright? After that, it says a taxpayer may choose to calculate his taxable income in ordinary way, ignoring the rented room relief, or he may choose rented room relief. It is advisable to choose the lower one, and an election must be made by 31st January. It says where election must be made by 31st January 1516, which is 22 months after the end of tax year concerned. Now there is a mistake here in the notes. It says election must be made by 31st January 1516. It is a mistake. Please make sure you rectify the mistake. You should write that election must be made by 31st January. That's it. Election must be made by 31st January, which is 22 months after the end of tax year concerned. So our tax year concerned is 1516. So 22 months after that, say for example, our tax year will end on 6th of April 2016. So after that, 22 months after that is going to be which one? 18, I think. So it is going to be 18, if I'm not wrong, I assume. So 31st January 2018 is going to be, so you must inform by 31st January 2018, which is 22 months after the end of tax year concerned. Alright? So please make sure you rectify the mistake. It is 31st January 2018, which is 22 months after the end of tax year concerned. Alright? Now the next topic is furnished holiday letting. Say for example, if you have a house outside the city, far from the city, on a holiday spot, somewhere in Weymouth, somewhere in Scotland, Edinburgh, or maybe in Italy or France, I don't know, or maybe in somewhere in Malta. So if you have a property in holiday place, and in holiday place, obviously, if you have a property, someone will not come to your house and live there for years. If you have a property in holiday place, then definitely someone who is coming to your property will only live for a couple of weeks or months, because it is a holiday place. No one is coming to live there permanently. They're coming there to spend their vacations, right? So that's why it is a holiday place. And if you have a property at that holiday place, it is called furnished holiday letting. If I have a house in Edinburgh by the beach, if I have a house, then that house will be called furnished holiday letting if I let it to someone. So all the properties which are situated in the UK and European Economic Area can be classified as furnished holiday letting. Now there are few conditions to be classified as furnished holiday letting. What are these conditions? Let's read from the notes. Now the conditions are: the letting must be furnished accommodation made on commercial terms. Is it furnished? Obviously, if you have a property in a holiday place, it will be furnished. If it is not furnished, no one is going to live there. Then it says, number B, accommodation must be available for letting to general public for at least 210 days during the tax year. So it says accommodation must be available for letting for 210 days. Alright? So if you have accommodation in a tax year, it must be available for letting at least 210 days. Then it says it must be let to public for at least 105 days, which is half of 210. So it must be available for let for 210 days, and it must actually be let for half of them, which is 105 days. Alright? Then it says during the year, accommodation must not be let to the same person for longer term occupations. Longer term occupation means more than 31 days. So you cannot let the same property for more than 31 days. You can only do let a property to single person for maximum of 31 days. You cannot do more than that. However, if you do that, then total must not be 155 days. Say for example, if a single person has came and you have given the property for 35 days, alright, that's one person. Another person came, you give it for 35%. So if you have keep doing it, a total must not be 155 days. Alright? It does not say here 155 days rule, but please make sure you know it. So total must not be 155 days. If you let to the same occupation, if you let to the same person for more than 31 days, total must not be 155 days. And in the end it says if a letting is classified as a furnished holiday letting, then its taxable income will be calculated according to the trading profit rules, which include capital allowances will be available on future on furniture. Now, capital allowances, what are the capital allowances? We don't know yet. We will see in a couple of chapters what the capital allowances are. Capital allowances is simply a depreciation on assets. So it says capital allowances will be available on furniture of furnished holiday letting. So it is a benefit. Benefit number 2 is income will qualify as relevant earning for pension contribution purposes. Now, if you look the previous lecture, if you watch the previous lecture and go to previous chapter on the notes, it says benefits of occupational benefits of pensions. Now, one of the benefit of pensions was that in the relevant earnings, you remember the maximum contribution on which you can get the tax relief. It is higher of relevant earnings and £3,600. Do you remember? Now, in relevant earnings, what is the relevant earning? Employment income, trading income, and furnished holiday letting. You remember? So it will be part of the relevant earning. That is one benefit as well. Then after that it says capital gain deferred relief. We don't know it yet. When we'll see the capital gains, then we will understand it. Capital gains tax, what is it, and what the deferred reliefs are. But for now we don't know what it is, so I'll just leave it. After that it says if a taxpayer has more than one letting, of which some are furnished holiday letting, of which some are furnished holiday letting and some are not, then draw up two profit and loss accounts, and there are two separate property businesses. This is so that profit and loss is treated as a trade profit can be identified. So if you have more than two properties which are furnished holiday letting, then you must do them separately. Alright, that's what it says here. Alright then, that is end of our chapter, and we don't have anything else left in this chapter, I think. Yep, yeah, that is end of the lecture. Now please make sure at this level you must be doing some questions at this level from practice and revision kit. Please make sure you buy one from approved learning provider and try to do at least MCQs question, because you are going to have some MCQs as well. Please make sure you do some MCQs every day so that you can make yourself comfortable, because we have covered enough of the chapters. We have covered almost 6 chapters, so you are now in a position where you can do some questions as far as income tax is concerned. Alright, that's it for this lecture, and I will see you in the next lecture with the most of ACCA taxation F6. Thank you and goodbye.